right, welcome everyone. I see we've got the numbers keep going up, but we're on the hour, so I'm going to get started as folks join. Welcome to the All About Taxes, Money Counts Financial Literacy Series put on by the Sokolov-Miller Family Financial and Life Skills Center. If you're joining us for the first time for these webinars, just love to do a quick introduction on what the Financial and Life Skills Center is. We are the hub for personal finance resources for the Penn State community. So we've got a lot of services beyond this webinar series that if you're part of the Penn State community, we encourage you to check out. Our website is a great place to sign up for and book various things that we offer, including group presentations where you can get a presentation like this for a group that you're part of, one-on-one coaching for students, and one-on-one coaching for staff through our partnership with PNC Bank, as well as a lot of other resources. So just wanted to highlight those, the larger services that we offer. But today we're here to talk about taxes. Here we are. We have a guest presenter today. So I'm very happy that we have this really strong relationship with the VITA program at Penn State because taxes are not my area of expertise. And it's definitely one that we sort of send out to the larger community of accountants and support. But primarily that consists of Professor Ed Jenkins, who's going to be presenting today for All About Taxes. I'll be in the chat monitoring. So if you want to see any links that are talked about, I'll be trying to put those in there. If you want to ask any questions, it's another great place to throw a question in, and I'll try and get that answered and bring it up to Ed. But let me give Ed a proper introduction here, as he deserves, and then we'll hand the reins over to him. So Edward Jenkins is a professor of practice at the Penn State Smeal College of Business. He holds a bachelor's and MBA from Smeal and a master's of taxation from Villanova Law School. He brings a wealth of practical experience in taxation, accounting, and finance to his teaching, and his expertise spans multinational taxation, mergers, and acquisitions, and he leads the Volunteer Income Tax Assistance, or VITA program at Penn State. Professor Jenkins is a member of the American Institute of Certified Public Accountants, Tax Practice and Responsibilities Committee, and is actively involved in the Pennsylvania Institute of Certified Public Accountants. He has participated in published numerous articles on tax, accounting, and business topics, including a recent piece on the ethics of using generative AI in tax practices and the tax implications of name, image, and likeness income for student athletes. Ed's dedication to education and community service has earned him recognition, including the 2024 Faculty Outreach Award from Penn State. I know we at the Financial and Life Skills Center are always delighted when we get to collaborate with Ed and pick his brain on all things taxes. So I'm going to hand the reins over to you, Ed. And if you need yours, I believe you can share your screen from here. So welcome, and we're glad to see everybody here today.
Thank you very much, Julie, for that nice introduction. Welcome, everybody. I'm really glad to have the opportunity to share some time with you to talk taxes, because that's the thing I do, and I love talking taxes. So let me share my screen a little bit with you and see if I can get this to work. There we go. And so today we're going to talk just really a brief overview of taxation. And there we go. Okay. So Julie, are we seeing my PowerPoint screens?
We sure are.
Okay, terrific. Okay, so just real quick, a little bit about, let me see if I can get this reorganized here a little bit. Kind of a little introduction to Volunteer Income Tax Assistance Program here at Penn State. That's a joint program between the IRS and Penn State to provide free income tax preparation for students and others in the community who qualify. We'll talk a little bit to sort of understand the tax process about filing status. That's a key concept to determine your tax bill. We'll talk also a little bit about scholarships and how those are taxed, because that's a big item for students sometimes. A little bit about self-employment income, because we have a whole bunch of folks that do gig work or other types of small business kind of things where they're an independent contractor and not an employee. And so that's a special category of income that has some peculiar tax kind of arrangements. give you a sense of when taxes are due, including the estimated payments and when the actual return is due, and then sort of highlight a few of the top issues that students face today. So those are our learning objectives today. So let's first sort of talk a little bit um, about VITA. So as I mentioned, it's an IRS program, and we provide free tax preparation services to taxpayers who qualify. And to qualify, the only big thing is you need to have less than $67,000 of taxable income. And so that's a pretty easy target to make. There's a very high level of poverty here in Center County. Believe it or not, it's around 16 or 17%. So we serve quite a few people here on campus, but we also serve some folks from the community as well. Now, some of the returns are out of scope. So even though you may fit under the 67,000, if you do have, cryptocurrency transactions, the accounting for which is kind of complicated, we're going to say, we can't really help you. Other things will be things like small businesses. So if it's a little gig worker kind of business, we're fine. But if you're doing things that are a little bit more complicated, we'll say that that's an out-of-scope return as well. At the current time, we do work with intercollegiate athletics to help support students who are earning name, image, and likeness income. Now, obviously, these are the students who earn less than 67,000 of name, image, likeness income and scholarship income. So those students that you hear the big stories about making, millions of dollars aren't getting served by the VITA program. But we do actively talk with and help folks figure out how the tax system works when you get that independent contractor self-employment income coming in through name, image, and likeness income sources for student athletes. We also provide educational sessions from time to time, particularly in the NIL area, for helping folks understand their filing obligations and payment obligations. Now, our webpage is already up and working, so you can schedule appointments, and we do fill up quickly. So if you're interested in having VITA do your return, please make sure you schedule your appointment soon, because we are very blessed to have new digs, if you will, out at the Wagner building. We're no longer at Buki. And so we do also have a few more spaces and volunteers, but even so, things seem to be filling up pretty quickly. You can also reach us by phone at the phone number that's listed there, 814-863-4147. And our suite of offices in Wagner are on the second floor in 216 Wagner, and it's the suite that's on the left side. You'll see some folks from our military services on the right side. So just make sure you're coming to the tax side, that's on the left. Now, Barry Rossman is our VITA coordinator. He runs the day-to-day operations of the VITA program. He looks at every single return to make sure it's done. Now, all of our volunteers are certified, and so our student volunteers, as well as community volunteers, staff, and faculty volunteers, all go through a training process, and they have to actually be certified to prepare returns. Now, you can reach Barry either by the phone to our offices, or you can reach him at the email address bgr2@psu. Now, I'm the faculty member who's responsible for the VITA program, and so I supervise the overall program, but Barry's the person who's running things there day to day. You can reach me at erj2@psu.edu. When you've got low numbers like that in your email address, that means you've been around a long time. So both Barry and I have been associated with the university for a very long time. As I mentioned, all of our volunteers are certified by the IRS, so they've got a pretty good idea of what they're doing. We have a lot of help from a student club. So our VITA club helps run things. They also, some of their officers are also our reviewers. So we have preparers who prepare your return, and then we have reviewers who review the return. And then, of course, as I mentioned, Barry looks at every single return before we transmit it to the IRS. So we have some student officers who are very prominent in our operations, John Dowd, Ashley Bowling, and Colin Shannon. So you see their contact information there. So if you're a little bit intimidated by the idea of getting in touch with Barry or me, you can reach out to one of the officers, and they're a student volunteer, and they may be more accessible and you may be more comfortable chatting with them, and you're certainly welcome to do that. So I'd like to talk a little bit about one of the key concepts in doing your return, and that's determining your filing status. So that's our next learning objective. And we have a handy chart here, and you can sort of use your finger to walk your way through this. So the key question initially is, first of all, I guess I really should put here, are you a US person, which would include US citizens and green card holders. If you're not one of those, then you don't quite get to this chart, and we have a different flow chart for you. But if you are a US person, the first question is, were you married on the last day of the year? So you can actually change your status if you get married on December 31st. You're considered married for the entire year, because our checking point is, of course, the last day of the year. If you are married, then we take a look at, did you live apart or did you live, together? So if you live together, you're going to file married filing joint as a normal kind of status. But occasionally there are some reasons where you might file married separately. As a general rule, your tax result is always better when you file jointly. So if you're married, you have two choices: married filing joint or married filing separately. Generally, you only do that if you're a little concerned about your spouse's activities. So you're generally going to be married filing joint. Now, if you're not married, then the next question is, did your spouse die? If your spouse did die in the current tax year, you get to file married filing joint. And that's important because you have a higher standard deduction for married filing jointly. If you didn't have a spouse pass away, then of course you take a look at, do you have kids and are you the head of the household? So if you're paying for more than half of the support of children, that could be a qualifying child, it could be a parent, it could be another qualifying dependent. So if you are paying and you're single and you're paying for the maintenance more than half of the cost of a home for those individuals, then you get the head of household status. And the head of household status has a higher standard deduction, which is very beneficial. So if you're not paying for everybody who's living with you, then of course you're going to file as single. And so the filing status determination determines what tax chart you use in terms of the tax rates that apply to you, as well as the standard deduction. So status is pretty important. Now, when we talk about qualifying children and qualifying relatives, there are some logical tests. And so to be a qualifying child, there is the relationship test, the age test, the residence test, and then the support test. Now, if you blow all of those, you may still be a dependent, because then you can go take a look at the qualifying relative test. So the qualifying relative test has a relationship test, a support test, and a gross income test. So here's a handy dandy chart that walks you through those tests for each person. Now, I'm not going to go through the details of that, but if you do, you're going to discover pretty much that you have to be a citizen, of course, or somebody who lived in Canada or Mexico for part of the year to even get onto this chart. And then once you do that, we take a look at, were you a citizen, resident alien, as I mentioned, and then we start going through the 4 tests. And so step 2, we take a look at the relationship test. So is the taxpayer's child, stepchild, eligible foster child? So there's quite a few different relationships. So brother, sister, half-brother, half-sister, stepsister, or any descendant, so that's downward, of any of them. So there has to be a relationship. If that's a yes, then you're good to go to the next one. So is the person younger than the taxpayer, number 1, and either under age 19 or under age 24 if they're a full-time student. So if you're yes, you're still okay for a qualified child. And as long as you provide more than half the support, so the dependent we're looking at is not providing more than half of their support, then that's still a yes. We move on to the 4th test. And then there's the residence test. So if you lived with a taxpayer for more than half the year, then that's going to be a yes. If you have 4 yeses in there, then you are a qualified child. But if you have a no in there, you're not cooked yet. So you can go look at the qualifying relative status of dependency. So again, we've got a relationship test. Notice that it's child, stepchild, eligible foster child, or descendant of any of them, brother, sister, or nephew, niece, parent, parents, sibling, grandfather, grandmother. So the relationship test is much, much broader for qualifying relative, and it gets actually even really very, very broad. The individual, of course, can't be a qualifying child of somebody else, and they have to have income less than $5,050. Now, item 5 is worthy of note. So you can have the relationship and pass the relationship test if you lived with the taxpayer. So if the dependent lived with the taxpayer for the entire year as a member of the household. So you don't even have to be related. But if you are providing support for a person who's lived in your household the entire year, then that will get the relationship test to a yes. So you may actually be a dependent, even though there's no family kind of relationship. So that's number 5. Now, the one that usually kicks out is the gross income of $5,050. So that will often be the one that may blow qualifying relative status. But if you get yes on either qualifying child or qualifying relative, then the person is a dependent of the taxpayer. Now, a couple of notes. That sort of number test, that income test, if you will, does not count your scholarship. So that's not going to enter into the calculus at all. Another important note is for the residence test, your residence here at college is construed to be a temporary residence. So you're still considered to be living with your parents when you have a temporary residence here at school. Now, even if your parents don't claim you as a dependent, you're still technically a dependent and you're going to remain their dependent. Your standard deduction is limited if you're a dependent of somebody else, usually your parents. So the limitation can be pretty significant. Now, the limitation really looks at the standard deduction. So if you're single and you're an independent person, your standard deduction as a single person for 2024 is $14,600. But if you're a dependent, the standard deduction is only $1,300. Or if you have earned income, it's $400 plus your earned income. Now, students who have NIL income, all that income goes into that calculation. So it's quite possible that a student athlete with NIL income could actually use their full standard deduction. Now, the standard deductions change each year. They're modified by inflation. The IRS goes through a formula. So for 2025, the single standard deduction will be $15,000, and the sort of standard deduction for a dependent will start at $1,350 or $400 plus their earned income up to that standard deduction in 2025. So last word I want to say on dependency is talk to your parents. Whoever files the return first is going to get in. So if you would file your return first as an independent single person, your parents' return will get kicked out when they go to file it. That's going to be a pretty unhappy conversation with mom and dad. So make sure you're talking to your parents and understand what they're doing before you make some choices that may affect your family. So let's talk a little bit about scholarships because there's a little confusion about those, and that's our third learning objective. So scholarships that are received by degree-seeking candidates are excluded from income, and that's up to the amount that is used for tuition, required fees, books, equipment, and supplies. Anything above those expenses is going to be taxable. So if you say, let's just say your tuition and your fees are $10,000 and you get a $15,000 scholarship, then the first 10 is going to be excluded from your income, but you're going to pay tax on the remaining 5,000. even if it's used for, your maintenance and your rent and your food and stuff like that, it's going to be considered to be taxable income. Now, scholarships received that pay for anything else, like the room and board, are going to be taxable. Now, some students receive a stipend in addition to their scholarship. If it's included in the scholarship, it as well will be included as taxable income to the extent that the scholarship and stipend exceed the qualified expenses. Now, if you're not a degree-seeking student, then the full tuition, the full scholarship is going to be taxable. Now, I'd like to chat a little bit about self-employment tax. This is kind of an area that gets a little bit dicey for students that have gig kind of work, where they're not an employee, but they're receiving compensation for their work. And this includes name, image, and likeness income. Now, self-employment income is a little bit peculiar because you don't have anybody withholding taxes from you. So you're receiving the full amount of compensation. That compensation is reported on Schedule C of Form 1040 when you file your tax return. Now, it's kind of nice because you do get to reduce the amount you received by your allowed expenses. So many gig workers are driving around and doing deliveries or doing Uber or Lyft. You're allowed deductions for the use of your car. So on Schedule C, you're allowed to take any deductions that were incurred that were necessary for your business to produce that revenue. So that helps reduce the amount of income on which you pay tax. Now, that tax is applied to the amount of revenue you received minus your allowed business expenses. And so with that as our sort of taxable income from the business, you're going to pay two different systems of tax on that taxable income. So you're going to pay self-employment tax. That's what we refer to as Social Security and Medicare tax. Now, the combined tax of that is 15.3%. So that's 6.2% for you, theoretically for your employer. So it's a total of 12.4 for Social Security, also known as the Old Age and Survivors Disability Income program. And then you'll pay 2.9% in total. That's 1.45% for each you and your employer. So if you're self-employed, you're your own employer. So you're going to pay the 12.4 in total and the 2.9 in total for Medicare. And so the total Social Security Medicare burden for a self-employed person is 15.3%. That's a pretty big number for many folks. Now, you also pay income tax. So if you're in the 10% or 12 or 22% bracket, you're going to also pay income tax on that stream of income. But you do get a deduction for half of the Social Security and Medicare tax that you pay. So the tax base is different for the Social Security and Medicare than it is for your taxable income for income tax purposes. So you get a deduction for, as I mentioned, half of the Social Security and Medicare tax that you pay. You also may be entitled to something called the Qualified Business Income Deduction, which is equal to, it's a deduction that's equal to 20% of your business income after the deduction for Social Security, half of the Social Security that you pay. So it's a little bit less, and that's a pretty nice, so you're really only paying tax on 80% of your business income, which is pretty sweet. Now, if you think about it a second and do the math, that's 15.3% for your self-employment tax, plus somewhere between 10, 12, or 22%, depending upon your level of income, for your income tax. You also have state income tax at 3.07% here in Pennsylvania, and depending upon where you live, you may have local income tax anywhere from 1 to 2.5%. So if you add all those percentages up, you probably need to put away about 30+% of the income that you receive, because remember, nobody's withholding taxes from you. So you need to put back about 30% of that revenue. And I recommend you put that into a separate savings account, and then you can make your estimated tax payments from that savings account without having a panic attack every quarter. Now, the quarterly payments are due generally April 15th, So for 2025, on April 15th, you need to pay in 1/4 of your 2025 liability if you're self-employed. June 15th is the next day, then September 15th, and then January 15th of the following year. So for 2025, you'll make your last estimated payment by January 15th of 2026. And that way you'll have your full tax liability paid in by the time you have to file your return. It's not going to be stressful for you because you've been putting away 30% of your business income into a tax savings account. And so you just take it out of the tax savings account and it's way less stressful. So you don't have any ugly surprises when all of a sudden you find out you owe a bunch of money for Social Security, Medicare, and income tax. So just in terms of what constitutes self-employment, so that's what we think of as a contract worker. We refer to that as an independent contractor. Now, that means folks that are driving for Lyft or Uber are often independent contractors. There's all sorts of litigation with Lyft and Uber about whether or not they're employees or contractors. So that may change at some point. They lost that case in England and a couple other countries, still being litigated in places like California. So there are a variety of kind of fuzzy things. We have what we call a 20-point test, where we actually evaluate the relationship between the paying party and the receiving party, who's also providing the services to the paying party. So we go through this checklist to determine whether or not the person has a relationship as an employee or as an independent contractor. And the IRS has the right to come in and test that relationship. So they can assert that they should have been an employee and then make the employer pay their share of the self-employment tax, as well as they can hold the employer responsible for the unpaid income tax if they're not collected from the person who's working for them. Now, in addition to that, name, image, and likeness income that's earned by our student athletes is generally going to be independent contractor income. And so we try to get to our student athletes early and often to say, hey, put 30% of that back so you can pay your tax bill and make your estimated payments throughout the year, as well as not have an ugly surprise when it comes time to have VITA do your return. So the name, image, and likeness income can be a bit of a surprise to students who are doing that because they'll get surprised by the fact that their scholarship is partially taxable, plus the NIL income for self-employment and income tax. They can get a pretty awful surprise if they haven't been watching out for their income and making sure they're putting 1/3 of away, roughly 1/3, into their tax savings account. And so that can be a pretty great stress relief if you're making sure you're putting that money away and not spending all of it. As I mentioned, the qualified business income deduction is 20% of the modified self-employment income. That's a very powerful deduction because you're only really going to pay 80% tax on 80% of your self-employment income. Now, if you've got adequate cash flow to pay your costs here at school, then you may want to take advantage of some special self-employment kind of opportunities to save through things like a self-employed pension plan. You can actually do a significant contribution of the amount of income that you have coming in. You can actually contribute that to a plan and get a tax deduction, reduce what you're paying income tax on by contributing it to a qualified self-employment retirement plan. So a SEP IRA can be very, very powerful for you. So I want to now just sort of talk a little bit about when things are due and when you have to make kind of payments and stuff like that. Now, your individual tax return for 2024 is due April 15th of 2025. Now, if you just don't have all the information that you need to file it, you are allowed to ask for an extension. The extension can be up to 6 months. So you can go all the way to October 15th before you file your return. Now, it's important to note that's not extending the time for payment. So 100% has to be paid in by April 15th. So you can wait till October 15th to file the return if you're one of those procrastinators. I know none of my students would procrastinate, but in any event, all of the tax has to be paid in by April 15th, even if you do want an extension to actually file your return. So as I mentioned, 100% has to be paid in by April 15th of 2025. You're going to get a penalty if you wait till then, because the law actually requires you to pay in that tax ratably throughout the year, generally on April 15th, June 15th, September 15th, and January 15th. Now, because of the weekend and holiday rule, if the 15th falls on a holiday or a weekend, it goes to the next business day. So here in our PowerPoint, you'll see the next business day on a couple of those dates, like on June 17th of 2024 and September 16th. That's why it's not on the 15th, is because those days fall on a Sunday or a Saturday. Now for 2025, the dates are a little bit different. It's April 15th, June 16th, September 15th, and January 15th of 2026 are the due dates for your quarterly estimated payments. Now, so there are different penalties. So if you wait till the end of the year, you're going to get whacked with the failure to pay estimated payments penalty. If you don't have enough money paid in, you'll get a failure to pay penalty. If you don't file the return, there's a failure to file the return penalty. And it's important to note that the filing of the return begins what we call the statute of limitations. Now, the statute of limitations is an important protection for you because it essentially creates a 3-year window from the later of when you file the return or the due date, April 15th. It gives the IRS 3 years to audit your return and propose adjustments. After that, they can't make any changes. Now, the statute doesn't start tolling until you file your return. So it's important to file returns timely and make sure you're getting that closure at the end of your 3-year statute of limitations. Now, a little bit about the actual tax return formula might be helpful. So as you think through what goes on your Form 1040 and how your tax is determined, we start with your gross income. And that'll include sort of the business income after expenses. But your gross income includes things like salary and wages, of course. It includes, income from your business if you have that. But it also includes interest, dividends, royalties, gains on the sale of property, rental income, less, of course, the expenses that you are allowed for your rental income. So gross income is very broadly defined under the law. In fact, the law that defines gross income defines it to say all income from whatever source received. So that's a really broad description. And so the courts interpret that really broad description as anytime you have some kind of accession to wealth, anytime you're economically better off, well, we call that gross income. And that's generally going to be subject to tax unless you can find a provision in the Internal Revenue Code that excludes that income. And there's a bunch of those exclusions. We already talked about one of them. That's the qualified tuition exclusion. So you don't have to include scholarship income in your return to the extent of your qualified expenses. So that's an example of one of the exclusion. Another example is, of course, municipal bond interest. So if you're investing in municipal bonds, say State College School District, that interest is going to also be excluded. So gross income starts with this very broad definition of all income from whatever source derived, less anything that's excluded by statutes. Then you're entitled to adjustments to gross income. And we already talked about one of those. That's the contribution to the simplified employee pension plan for the self-employed individual. But there are other adjustments that may apply to you. So after we reduce gross income by adjustments, we're left with a number called adjusted gross income, or AGI. That's an important number because it serves as a threshold determinant for a bunch of calculations in the tax law. We then are entitled to 2 deductions, the greater of our itemized deductions or our standard deductions. Now, the standards we kind of talked about for a single person already. We'll talk a little bit more about the other filing status standard deductions in just a few moments. Here's where you also see the deduction for the qualified business income that I mentioned. So we take AGI, we reduce it by the higher of your itemized or standard deduction, we reduce it by the qualified business income deduction if it applies, and that gives us our taxable income. We then apply the effective tax rate to that income that determines what our liability is. And then if we're entitled to any credits, we reduce that liability by the credits. We also reduce it by any prepayment. So if you had money withheld at work, that's going to reduce your liability. If you made those estimated payments we just talked about, that will also reduce your liability. And so the government may end up owing you money. We call that a refund, or you may have to write a check to pay the rest of your remaining liability. Now, tax credits are fun. Your parents may qualify for the American Opportunity Tax Credit, which is related to the costs incurred for your education. There are a couple of other credits that may apply. I'm a big fan of credits. I like the electric vehicle credit. When you buy an electrical vehicle, you can have up to a $7,500 credit to help you offset the cost of that vehicle. So this is the overview of the individual tax formula. So gross income, broadly defined, less amounts that are excluded, less any adjustments to gross income, give us AGI, minus the higher of your itemized deductions or standard deduction, minus any QBID, qualified business income deduction. That gives us our taxable income times the tax rate, gives us our tax liability less any credits or prepayments, and that's what we're going to owe or have as a receivable. So I have some handouts that I do want to share with you. So I'm going to stop sharing my PowerPoint for a moment. And Julie, I'm hoping that you've made those available to our students through download.
You want me to put them in the chat?
Yes, if you could, that would be terrific.
Yep. Take me 1 minute, but I'll put them up there. If you want to screen share in the meantime, that might be.
And so I'll share that screen and show you what they look like. And so the first one are key numbers 2025. I'm going to see if I can get that a little bit bigger. And so this is a document that shows you what the tax brackets are for each filing status. So we've got single, married filing joint, married filing separate, and head of household filing statuses. And so this is how you calculate your tax. So you use these tables, and so you kind of build up the tax bill, if you will. This document also includes the standard deductions here, as well as the additional deductions. If you're over 65 or blind, you get a little bit bigger of a standard deduction. We also have some information here on education credits that may apply to you. And there's some information on investment taxes if those apply to you as well. So these are pretty useful documents. I have a second one for you. Let me get to that one. And the second one is, if you're really into this, this is the comprehensive key numbers for 2025. And this has a lot of the thresholds as well as the tax rates. And it's nice because it gives you the comparative numbers between 2024 and 2025. So it's got your deductions for charity. It's got your earned income tax credit. So there's oodles of stuff in here in terms of exclusions and thresholds, in addition to the tax rate tables and the standard deductions. So it's a pretty useful handout that you may find handy to keep around. I also have one other one I'll share with you. I can get to it. There we go. And this is the income tax key numbers. It's kind of a short document for quick reference. but it does give you, the nice thing, it does give you the 2024 versus 2025 amounts in a little bit sort of different of a presentation. Also gives you the mileage rates for business as well as charity and medical purposes, which may be important to our gig drivers for Uber and Lyft and that kind of stuff. So let me jump back out to our PowerPoint here now. Share that screen. There you go. Okay, so that was a little bit about when things are due and estimated payments and putting money away in a special tax savings account so you don't have a stressful payment time and you kind of understand what your obligations are. I do want to take a moment now and talk about some of the top issues facing students today. The first top issue is the IRS. So the IRS is problematic. They've got over 90 systems out there that they have to keep up to date. And some of those systems are written in a computer language called COBOL, which you probably never heard about. But if you were growing up in the 60s and 70s, COBOL is the common-oriented business operating language. It was a programming language from the 70s. So the IRS can't even find people to maintain the programming at this point. So if you do run afoul of the IRS, you're going to have to hire help. And when you hire help, you lose because we're expensive. So attorneys and accountants are going to charge you a significant rate per hour, and they're going to end up sitting on the phone waiting just like you might. And it's very easy to run up a lot of hours. So if you do get a question from the IRS, especially as unfunctional as they are right now, it can be an expensive endeavor. So the moral of that story is keep your stuff clean and don't try and hack or scam the government. Don't try and not report the business income because when you get caught for all the years that are open. And if you intentionally defrauded the government, there's no statute of limitations protection. So the moral of the story is it's not going to end well if you try to hack the government. Now, there's a lot of news right now in the tax world. The biggest one is the Tax Cuts and Jobs Act. That was the big act passed in 2017 during the Trump 1 administration. Well, guess what? That was temporary. So many of the provisions of the TCJA are done December 31st of this year, and we're going to go back to the law in existence prior to 2018. So Congress, and I'll let you assess whether or not you think Congress is capable of functioning at this point, but Congress has to pass a bill to re-up some of those provisions, and many people like these provisions in the Tax Cuts and Jobs Act. They're going to have to do a tax bill this year, whether they like it or not, or it's going to revert to old law. In addition to that, we are facing a government shutdown again and again and again. We exceeded the debt limit in January. Now we can do some sort of machinations of the ins and outs of cash to kind of keep us afloat until the fall. But basically sometime in the summer or fall, we're not going to be able to borrow anymore to pay people anymore. And that could cause a shutdown. In addition to that, we have the continuing resolution since Congress was unable to pass a budget for their fiscal year beginning October 1st that runs through September 30th of 2025. They passed a continuing resolution. This is their second CR. And so we are good until only March 14th. And that's when the government will have to shut down if Congress doesn't either pass a budget or pass another continuing resolution. And I'll let you self-assess whether or not you think Congress is capable of passing laws at this point. They are very, very challenged because of the slim majorities in Congress to get bills through Congress right now. Now, a couple of other things that are important to note. Form 1099-K reporting got delayed again. So for 2024, the 1099-K reporting is going to be at 5,000 in gross receipts or 200 transactions. For 2025, it is going to drop down to $600. Now, what 1099-K reporting is about, it's The Venmo, the PayPal, the non-bank, kind of non-credit card, if you will, reporting is going to be opened up. And so you're going to have to pretty much identify the type of payments you're making as whether or not they are income generating payments for these alternate payment processors, or if there are like reimbursements or gifts, or many students share expenses in their rent. And so 2 or 3 students might actually send Venmo or PayPals to one student who then pays all the rent. Well, that student is going to have to make sure that that's identified as reimbursement and not income, because the IRS has a matching program. And if 1099-K says you've got 10,000 or 20,000 of income, and they don't see it in your return, you're going to get a letter from the IRS asking you to explain it. So 1099-K reporting went down to 5,000 for 2024. 2025, it drops to $600. So they're going to get a lot more 1099-Ks at the IRS, and they're going to be looking to match those to people's returns. Now, cryptocurrencies and digital assets continue to be pretty problematic for both the IRS and taxpayers. The IRS construes cryptocurrencies transactions as transactions in property. So every time you sort of use your Bitcoin for something, you're actually having a gain or loss on disposal, just like a share of stock or a bond. So you've got a lot of reporting. And so remember, if you just use, I don't know, $10 to buy something in Bitcoin, well, you've got to identify which Bitcoin you gave up and what their basis, what you paid for that Bitcoin. And that's not very easy. So if you are dealing in cryptocurrency or digital assets, run as fast as you can to one of the software providers who will help you track your basis. Now, as I mentioned, VITA will not do your return if you do have cryptocurrency transactions. In addition to that, there's a question asking you on your return whether or not you have any dealings in cryptocurrency. It's important to point out that at the bottom where you sign your tax return, there's a perjury statement. So I wouldn't recommend lying. Remember that perjury, lying to a federal agency, is a crime. So welcome to a new wardrobe that involves orange jumpsuits. So don't lie on your tax return, and make sure that you're correctly completing the question on cryptocurrency and digital assets. So starting in 2025, the exchanges that hold your wallets are now going to be reporting to the IRS on Form 1099-A or 1099-DA. And so your transactions are going to get reported, and the IRS is going to expect to see that activity on your return. I should mention that generative AI is really altering a lot of what we do in the tax world. I would encourage you to be open to learning about generative AI and using tools like ChatGPT and Copilot as it's changing business models everywhere. So it's going to change the tax business. And it's also going to make it very easy for you to learn about taxes. If you have a tax question, just ask Copilot. Now, not so great for me because I'm going to have fewer questions. But remember that generative AI is learning and dynamic, and it doesn't always get the answer correct. So you do have to check it. Last but not least, if you do have an interest in an entity, I do want to make sure that you're aware of beneficial reporting requirements from the Financial Crimes Enforcement Network. So it's on hold because of some court cases right now. But if you have an interest in an LLC or a corporation that is formed under Pennsylvania law or the law of any other state, then you may be required to do what's called beneficial ownership reporting. And if you do have an interest in LLCs or a corporation that's formed under state law in any state, you may be required to complete these reports. And it's easy, it's pretty simple, it's all online, but the penalty for not doing it is 10 grand a piece. So you don't want to run afoul of the beneficial ownership reporting requirement. I do want to shout out to Sokolov-Miller. A lot of students don't have a budget. A lot of students don't reconcile their bank accounts. And I want to emphasize that banks make mistakes all the time. In addition to that, We forget about some transactions, and it's very easy to overdraft your account if you're not reconciling every month. So please, for God's sake, please reconcile your bank accounts. Please also do a budget. And our friends at Sokolov-Miller Financial and Life Skills Center have some great opportunities to learn how to do a budget. So I encourage you, for a stress-free life, to manage your money well and use a budget. Now, for those of you that do have a business, there's a couple of sticky things you probably ought to check. You should consult with an attorney to determine whether or not your business activities need an entity like an LLC or a corporation to protect you from liability for your self-employment activities. You also should consult an insurance advisor to see if there's any liability or property and casualty insurance. If you're doing, gig work like Lyft or Uber, you better make sure that your insurance policy covers that, because you can have an accident while driving for a company, and if your policy doesn't cover you for business activities, you could get a very unhappy surprise if there is an accident. Now remember, PSU VITA is here to help you. So if you have less than $67,000 of taxable income, we're happy to help you do your return. And you can schedule your appointment on our webpage, and there's a link to that webpage right here in the PowerPoint. Please note that if you're not a U.S. citizen or resident, there are some other complicated rules. Now, we do at VITA help non-resident students with their returns, but we do have scheduled nights for international returns, and those appointments fill up quickly. So if you're a non-resident student, you might want to book your appointment pretty quickly. So we are down to our time for questions and answers. So Julie, I think we're almost out of time. I tried to sort of end at 12:50, so we had some time to take any questions from our audience. Let me stop sharing the PowerPoint.